All right, so in this video, I'm going to talk a little bit about why monetary policy might be a little bit better in terms of a response to recessionary environments and things like that, or even to tamp out inflation and so forth. One of the main reasons why monetary policy might be more effective in those kinds of things is basically when the Federal Reserve changes that Fed funds rate, that change in interest rates is affected almost immediately. The Federal Reserve basically engages in those open market operations to essentially force some of those interest rates to hit that target. So they're trying to force that Fed funds rate to hit the target, and basically they're engaging in economic activity in the markets, buying and selling securities, what depending on the situation, to achieve the outcome they want. And so that is going to then produce an effect that filters through the rest of the economy in various ways. If, for instance, the Federal Reserve is trying to lower rates, they go out there, they buy up a whole bunch of securities, they're putting a whole bunch of money into the economy. The money has to go somewhere, and it will go somewhere. And so that tends to have an effect that starts to filter through the economy almost immediately. Now, having said that, even though the Federal Reserve could do that to try to stimulate the economy, economic recovery can still take significantly longer. I mean, ultimately, even though the Federal Reserve could pump a whole bunch of money into the economy, businesses and consumers have to take advantage of the lower rates. Businesses and consumers have to spend. Basically, economic activity has to resume, and you have to have more of that economic activity. So just because the Federal Reserve has pumped a lot of money into the economy doesn't automatically mean that things are going to recover immediately. Also, it's worth noting that when you pump all that money into the economy, inflation is essentially that too much money chasing too few goods. So the Federal Reserve could pump, 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 pump money into the system, so just shoving money into the system. But if the money isn't chasing any goods, you won't really get inflation out of it. So if everybody just takes their money and sticks it in the proverbial hole in the backyard or stuffs it under their mattress, as it were, then it won't really turn into inflation. And so the Federal Reserve can kind of shove money in, but it doesn't necessarily make anything happen immediately. It can take a little while. People ultimately have to choose to borrow and spend or use the money that's now floating around in the economy. Um, Now, when they do start using it, you start getting more economic activity. Eventually, at some point, as the economy grows and starts to spin back up again and starts growing faster, eventually all that money that's floating around starts chasing goods a whole lot more. And once all that money chasing goods occurs, that's when the inflation starts to tick back up again. And eventually, the Federal Reserve hits a point in which they have to essentially reverse that process, sell off some of those bonds to pull cash out of the system, and basically raise the rates to essentially deal with the inflation that's starting to rise. And so, if they're on top of things, they try to slowly raise the rates to kind of ease that money back out of the economy to keep inflation from getting out of hand. And so, the Federal Reserve is trying to keep things relatively stable and consistent there. Now, in terms of the effects of the monetary policy and so forth, one of the challenges here is that businesses and consumers do have to take advantage of the lower rates and do something with it. And what if businesses and consumers are near their borrowing capacity? If they're in debt up to their eyeballs and things like that, providing lower rates, it just may not help them much because they may have too much debt at this point. And that's what something called deleveraging may need to occur, in which you just go through a period of time in which businesses and consumers basically do the hard work of actually paying off debt. And in that case, there may not be as much of an economic boost from the lower rates because basically the consumers and businesses are just kind of sitting there working their way through paying off the debt they previously incurred. They're not in a real hurry to incur more. So if debt levels are excessive, to start with, the lower rates may not be as stimulative as would be hoped, basically because that deleveraging has to happen. But in general, the monetary policy is pretty much generally faster than fiscal policy typically, because as soon as the Federal Reserve makes their determination on the direction of the Fed funds rate, they engage in those open market operations to get it there, and pretty much they keep engaging those operations to keep it where they want it. So as a general principle, for the sake of trying to manage the economy and trying to, manage the growth and inflation, things like that, monetary policy is probably going to be something that the economy is more responsive to in a faster manner. Fiscal policy definitely matters. It's a big deal. But also tends to be a lot slower. It tends to have much longer effects. Congress has to make a decision on things. President has to sign it. It has to be implemented. It's kind of a long runway there before things could perhaps really take off a good portion of the time. And that's not to suggest that fiscal policy doesn't matter. It absolutely does. And government policies do matter for sure. It just might skew towards being a little bit more long run implications, maybe not quite as much short term, almost immediate kind of effects. All right. Hopefully this video has been helpful. Thank you so much for watching. Have a great day.